Mistake, I made a mistake, and find a way, let's say, main objectives work together and make this thing work out, instead of taking positions and sides and splitting everything on it. Just keep the focus of the company and stay together is what we need to do.
And again, I would not beat these things to death if I didn't think it was really important for our company's financial future. Okay, I don't really have much to gain here as a board member. We receive our salaries, but we're very limited in that. We're not here to make a ton of money off of the company. We're really here to look out for the interest of the ratepayers. So I'm not here trying to defend, a little salary or benefit for me. Okay, I'm here to say, can the ratepayers sustain this? Ratepayers are already loaded with debt, and more debt will be coming.
We understand that as a board too, collectively too. But I think
and the projections of what the impact is to the ratepayers are in the strategic plan that's been published year after year.
Well, I think I understand math. I passed it in school. I think I done all right on it. I'm a hair bit offended that you would say not. For me, I look at the total principal owed is $3,610,000 on the 2002. On the 2012, it's $3,735,000. There's a difference of $125,000 there. If you look at the interest, it's $1,455,000 on the 2002 bonds, and on the 2012, it's $844,000. It's $600,000 difference. You take that minus the principal, obviously there's more money borrowed on that. You're paying back more. That gives you the savings. It's as simple as doing math.
Okay, but when you add in all the interest that we're going to pay after 21 years.
No, you don't. You look at the total. You just look down at the total. The interest in that many years after 2025 is $1,455,590. That's the interest.
So when we come back here to the bond schedule, and we look at the total here, and we look at the financial statement too. Remember it said in the financial statements, and I can pull that out, what the total would be with the principal and the interest. We were looking at over $14 million of debt.
I'm talking the 2002, 2012, then we can go back and do the 2010 debts and add them into it.
This only goes to 2025.
Yes.
We have to go, far beyond.
When you go back to the 2010s, you do, but the others don't.
That's when the bond ended, the 2002.
Yeah.
Instead of the 2012.
Yeah.
Yes.
They end in 2025. Then you got to go back in and add in the 2010 A and the 2010 Fund America. You add them into it. But this, if you compare these, that's the savings of those. You want the total, you just add the two up. It's that simple.
Well, all I can do is go by this information that they've given me, and I am trying to pick it apart and figure it out as much as possible. And scrolling through 113 pages, I'm trying to find one graph that shows a total. So I'll keep going, Joe. I'll keep going, okay?
Well, I think I can tell you what it is, because all you got to do is look at the 2010 and add it to the 2012, and that's what it is.
It only goes to 2025.
On the 2012.
2010 is going to schedule up to 2035.
Yeah, 2035. So you just add that to it. Right there it is.
7.3.
Yeah.
We got a Build America subsidy of $2,360,000, which
So they're saying.
wasn't acknowledged, I don't believe, in the public hearing.
Okay, let me show GJ. Let's see what you think here. Here's the 2012 bonds. Right there at the bottom, I'm looking at that.
It's got a glare on it, I'm sorry.
Looking at it bigger. Is that any better? 2012 bonds right there. 2012 bonds, go to the bottom. There's one of the figures, 11.2 million.
That's got to be with them added together.
That's
Go
right,
back.
it goes all the way to the end.
No, see, she's got the 2035s on there.
Yeah, it goes all the way to the end with the interest.
The 2012 doesn't go to the 2035, do they?
Excuse me?
They go to 2025.
They go to 2025.
Okay, but see, these are the other bonds too.
Yeah, but what I'm saying is, what you got to do, Heidi, is the 2012 bonds are right there. So you take those, and then you add them to the 2010s of the
Well, the 2010s were 2010, was one of the
No, they're
2002,
together.
refinanced by the 2010?
No, just the 22.
2012 was refinanced.
2002.
2002 bonds was refinanced by the 2012 bonds. The 2010 bonds have not been refinanced, there's two of them. There's the Build America bond and the 2010 A bond.
Okay, so
And
where
that's
are
the
these
number
figures
you're,
coming from?
them are the 2010 bonds added to the 2012s. That
Okay,
11,277 is the 2010s plus the 2012s.
Okay.
The 11,277 on here looks like it's just the 2010s.
I'm sorry, I didn't hear the question.
Isn't that? The 11,277 looks like it's just the 2010s on this spreadsheet.
Yeah, this-
Yeah.
That's what it
The
is.
bond schedule.
Yeah, so it's not with the 2012s.
No, that's over there on the
Okay,
other
so
side.
So it goes up
Is the 22.
22.
15.8,
Okay, so where's the 15.8 coming from?
adding those two together.
Adding
right?
those two together.
The total for the 2010 and the
So
total for
it's
the
worse than I
2012.
said? So
I don't know
instead of
what you
having,
said.
I said we had over $14 million. This total debt service is saying 15.8.
That's how much they'll pay over the life.
Right, for the next 21 years, right?
Up
So
until
it's
20,
it's worse than what I said,
up until
Jay.
2035.
It's worse than what I said. It's $1 million worse.
If you assume that debt's bad,
Well,
all debt's bad, and you've done the analysis.
you know, it's not that the debt is bad, it's just everything else that goes along with it. And then it turns into a really unsustainable thing.
And it makes it very amorphous, so it's difficult to
So
quantify.
I can go by the 15 million now, right?
Well,
Not
but when you say
14.
that, Heidi, that's principal and interest.
That's what I thought the 14 was, Jay.
Oh, okay, no, it's
So now it's 15.8,
862,301.
okay, for the next 21 years. With
Well, it
interest
pays
rates
off
varying
in
from
tw-
3 to 5% because of the subsidy,
Right.
right? I want to make sure we're clear on
And
this.
during that time period, we'll have gross income in excess
Okay,
of
so-
millions and millions of
All right.
dollars.
So now, because the bond's been downgraded, are we going to be able to get 3 to 5% interest rates anymore for the future?
We'll find out, won't we?
Yeah, we will find out.
But it
and-
doesn't have anything to do with what we're talking about today, because we haven't presented you with a bond to analyze yet.
Well, to me, it has quite a bit to do with
I know it
today
does, but it
because
doesn't to most
we have to
people.
resolve the governance concerns. And we need to make
Which
sure that
which
any,
governance concerns?
the governance concerns?
Yes.
Oh, well, I would like to see all the money returned from the payment in lieu because you did pay $600 for that report last month and we still haven't seen the report of the money
That's my
outstanding.
fault. I've been busy screwing with this.
And then also, we're very concerned about the other issue with the furnace trial, which has yet to be resolved. I still have not received any explanation on why the previous board didn't make the insurance claim to recover those costs.
So, but of those, the only one that has anything to do with money is the last one.
Well, we've lost over $230,000 with Mr. Furness
And
on the audit, the
Fit-
security, and the outside legal costs, and I would love to see some of that recovered.
Fitch looked at all of those things. That has nothing to do, it was
Okay,
also,
so Joe?
no, let me finish.
Okay, and then I'll explain.
Then Fitch looked at all of those things and specifically found that they were not material, both governance and finesse.
You know,
And-
how can they think that that money's not material to the company's position?
We've got 4,000
But to
out
me-
to Horner. He's not gonna repay it.
Should we sue the city? That's our option.
Yeah, I mean,
That's
4,000
totally
out to
fine with
Horner
me.
that's not gonna be
That's totally
repaid.
fine with me, because then the
Robert
city
Patterson
can make-
is repaying his out of city funds. It was decided by the old board, and I think appropriately so, that we need to get out of the litigation on the Furness thing, or we're gonna take a dive even worse than these bonds up here at this time.
So what
These
the
are things
insurance
that are-
decision?
These are things that are not worth taking our time for.
No, but see, as Joe was
These are under the
saying,
bridge.
Joe was saying that they went to Fitch this year to try to get a higher bond rating.
I
and
didn't say
Fitch-
that.
No, we didn't.
Okay.
We did
You
not.
said in your presentation that you were hoping in San Francisco to get the higher bond rating. You just said that, right?
That's when that was 2012.
That was
Okay,
in 2000.
but we didn't get it. To me, we're going in the wrong direction when it comes to these bond ratings, and I don't want to see us
How do
keep
you
going
deal,
down.
how do you deal with Fitch saying that we're stable then?
When I talked to Mr. Paderni
Oh, this
in
is
San
good.
Francisco, oh,
Because
I have the notes of everything that I told him.
because if you, I would go,
and
I would
everything
go,
that he told me.
I would go slow here, because, see, the thing is you need to understand is that press release is Fitch's statement. And
I
if
understand
Mr.
that.
Perdurny said something different from what's in the
He didn't
statement.
say anything different.
Okay,
He
good,
said-
so, but that is their
But see, now
statement.
look, Joe, you have to understand here. I have studied
That was
law and
somewhere
legal
else,
standards
at a
for
different
decades.
But you're
So
not getting
I'm
the
not
idea.
naive when it comes to trying to deal with bond rating agencies.
Yes, you are, because you would have never published that piece of.
I would have.
Joe,
Let's call this back.
Oh, but everything was cited to the pages, Joe, so you're telling me that where I got the material from was wrong.
Heidi, we're
Yes.
calling this back.
Well, that's too bad, because everything was
Heidi,
cited to these pages.
Enough.
Okay, what we'd like to do is have an opportunity, I think Joe and Blaine would like to sit down with you for a minute, when you get an opportunity to get off work, and some of this explanations you need from them and they need from you, sit down and work it out a little bit. If you wouldn't mind doing that.
And if you're busy during the day, we're available in the evenings or early mornings.
I'd recommend you set a time right now,
I've looked around.
because it's been my experience that I've said numerous times, come by the office and give me a call, and I never received either, so.
Well, that's true,
Set a
because I
time.
didn't move in the
Set a
last
time
2
at this
weeks, and
meeting.
you know how hard it is to move a household.
Actually, I just built a house in the last 2
Well,
weeks,
you can
so.
understand how much time that
I
takes
put
to sell a
45
house
hours
and
in
move.
between Wednesday and Friday night on my house alone.
Are you building it, you said?
I did.
Oh,
So
no,
don't give me any crap about it taking a lot of time to move, because I did all that. I know exactly what you're talking about, okay?
Back.
My thing is I've been hit a couple times in this meeting. Mr. Miller never provided this, but I left it under the understanding that I had it at my desk, right here.
Mr. Miller,
Are your
when I
bank
asked you
recs.
for information, you have deferred me to Blaine, and Blaine has not given me the information. So I know when a door is shut in my face. And I know that when I go to Mr. Stewart, he's shutting the door in my face. I get your messages
How
loud
many
and clear.
times did I send emails to Bob Koalas trying to set up meetings with you and Colleen, starting back in February about the employee compensation issues? And
I wasn't
and what
aware of those
and what-
emails,
and what
It's
tri-
been since February, hasn't it,
and
Bob?
what triggered your ultimatum to us to provide that was an email from me to Bob saying, look, in April, I give up. I don't know if we're ever going to have this meeting. Why don't you and I meet?
So all of the times you told us the salaries were confidential and we couldn't get the information, you were also then thinking that you were going to tell us in this meeting?
They're confidential to the public, but
we
not
need
to
to
the
stop.
directors.
They're
Move
not
on.
confidential any longer.
I know, you've reached that confidence.
We'll move on.
Yes, now the ratepayers know.
Next item we have before us is the financial and bank reconciliations for May.
Clark's going to make the budget presentation, and he'll show you where we're at, where we're forecast to be, and offer some explanations.
I was asked to put together an understanding as to where we currently stand. I believe the chairman there asked, actually, when the auditor was here, to kind of walk through the financials, get a good understanding where we were at. And I don't feel like he got a good answer, and I regret that I wasn't able to provide that last meeting. I kind of spaced it off, to be honest with you. So, today what I wanted to show you real quick is where we stand with our budget, where we stand with our forecast according to current rates, and where we would stand if the proposed rate effect took place. So our budget was showing that for 2014 you'd be looking at $14.2 million of income. With our current forecast, meaning actuals through May and then forecasted for June through December, we're actually looking at coming in about 14, just over 14 roughly. So we're actually projecting less revenue under the current, and that's because our budgeted amount included 9 months of a 4.5% increase. So you'll see that we've actually, if we had that 4.5% increase, we'd actually be looking a lot sweeter on the year as far as our revenue stream. But as it is, we are within range of being able to absorb it if we have to. You'll see that if we go with a July 1st implementation of that rate increase, we will exceed our 2014 budget on the revenue side. Now, that's revenue. Expenses usually the bigger beast. And I think Joe alluded to this when he was speaking, but you're gonna find as you go through these, and I have hit it heavy for some time, there is very little wiggle room. Those first two line items, I don't care what you do, it is extremely difficult to have any wiggle room at all on those, and they are your biggest. Okay, the third line item there obviously is heavily contentious, as discussed even today. So, short of going in and telling the employees that you're cutting their pay, I don't know how you got very much wiggle room there either. The board compensation hasn't been broken out, although it was broke out in the budget, so I started to break it out separately. And we can go down through these. The liability, I've used accrual accounting on that more. We paid it all.
Is that just the increase in the cost of the 641 to the 945 on the generation, maintenance, and fuel? That's just the market increase on the rates out of fuel. Holy cow.
Why such an increase in bar?
That's
I
just,
don't control
Aren't you seeing it at the gas
pump?
pump?
And that's just the energy cost.
Well, it's gone up, what, 20 cents for us over the last several months, but it must be going up quite a bit more.
You're talking petroleum
On the
fuel?
fuel.
This is natural gas.
You're talking fuel for the generators?
And this is all contingent upon the market.
Well, and then more use. I mean, we're using
We're using more,
we got more customers.
What's that point?
but it just seems like a lot for 1 year. I'm just curious where
Yeah.
that was coming from.
Well,
The
and then
cost of, because we had a few sweet years with that natural gas being really cheap, and now it's
Now it's
over.
going up.
Now it's over.
so, I mean, that, and every year that number will continue to refine, and some years we'll actually see a favorable variance. This year, it's, as of right now, the forecast is showing an unfavorable variance to the tune of 3 million.
When can we get this in the handout, please?
You get, as far as the forecast or
Just this.
the budget,
This is pretty much,
it's pretty much what you got there.
in your April, May financial statements. We get this every month.
The same line items, but without the forecast.
What is this Wednesday?
I don't think that we're gonna get anything less. I mean, the figures
Print it
match.
out.
The only thing different,
Come Wednesday
just
in
for
our
everybody's
packet.
knowledge.
Put it in our packet.
Right.
is
It's in your,
this has the forecast for the rest of the year.
this sheet is not.
Because I was asked to say, hey, where do we stand on the year? So I've added this in as a forecast for
So
the
that
rest of the
is
year.
the main difference.
Yes. See, like what you're seeing there
Let's get a
is
copy
the
of that.
January through May numbers. If you used to take those numbers, less those, or away from those, you'd see what we're forecasting for the remainder of the year, meaning June 1 through December 31. I can send you this PowerPoint as soon as we're done here. But anyways,